So that's inventories, which are rising and to the moon and beyond.
Because this is all the stuff people
the other thing you see is not only are savings rates declining, but consumer loans are exploding. So they've run out of cash. They're on their credit cards. I went out to dinner last night in the city. I mean, the restaurants are packed. Chicago's packed. Miami's packed. And you kind of like, who are these people? And they're actually now on their credit cards. So it has to end. The spending spree that was stimulus-induced with no savings and on debt, it had to end. So the Fed is really the icing on the cake. I mean, and now they're disrupting and will destroy future growth of the economy, lowering the growth rates because companies won't build plants. We won't build. The real estate complex will grind to a halt. And so they will hurt future growth. And I think the third most important chart, and this one is key, is the CPI. They got to bring that up. What's actually happening in CPI and why the inflation is going down. Nope.
Year-over-year growth
comparison
for actual
that's it. So the orange line is actually what the Fed is reporting for rental growth, and that line was up like 0.7 last
just
month.
Just because CPI doesn't accurately reflect what's
but
really
look
happening.
at the blue line. That's actual rents. Actual rents have turned down, and the government's reporting them going up because of the lag.
Right.
And so you will see in 4 months' time the CPI, a third of CPI is this rent growth, and it's going to go down. So the CPI is going to fall. And look at the other components of CPI, oil. And we're going to frack and drill our way to happiness in the United States. We have plenty of oil. Mm-hmm. And now money, because it's really a really interesting place. You can get great returns investing in carbon because nobody wants to go there. You're going to get oil prices calm in the United States. Gas prices are already down to 4.5 cubic foot for gas. So inflation is coming down hard, and it is coming down a lot faster than I think people thought. And I've actually been surprised at how rents are sort of rolling over. And they're growing still, but they're growing at a much slower pace. And that's what the data shows.
The pandemic was this crazy time. A savings rate of 3.5% and people taking on consumer loans is not surprising. That's just a reversion to what the
to normalcy,
to normal
right?
times.
To normal times.
So it was this crazy, like, pig in the snake, or whatever you want to say for it. However, it's gotten into wages at this point because people have been able to go to their employers and say, we're not making enough to get by. Unions have come back with some pretty tough negotiations. And that's where you wonder, okay, it was the supply chain that caused it, all this excess money from the pandemic, but does it work?
Well, we talked about there is not a supply of goods. There actually was no supply of labor. People weren't back in the office. They were working from Montauk and Jackson Hole. Kids were flying around. And even today, the older people over 55 and younger people less than 24, they haven't re-entered the workforce the way they had prior to pandemic. I assume in a recession, they're going to come back. But you've had a labor shortage, and that led to wage growth, right? And now what I'd say to the government is there's 1.7 million worker visa applications. It's up from 1 million under Trump. If you want to lower wage growth, add more workers to the worker supply, encourage immigration, immigration's down to like 200,000 people. We used to allow 1 million legal immigrants. We need to increase the amount of workers, and I need them for my hotels. We're still not staffed properly. And ask any, I talked to the CEO of Marriott the other day, and I was over in Europe talking to the CEO of Sol Malia. Nobody has labor. So increase the supply of labor. I tried to hire a woman from Norway yesterday. I can't get her a visa. I can't get her into the country.
If oil does what you think it's going to do, and if rents do what you think it's going to do, where would that leave inflation? Because we just had Shrion. He said it's going to be stuck at 5.
I disagree.
So they're going to have to go.
I think it'll be in the 3s, and I'd be delighted. 3s to 4s. And I think
next year?
Yeah, sort of middle of next year, after that CPI number comes down for rent. And here's the issue. Like labor, you're right 100%, Becky, on the unions. Like the biggest increase I've actually heard, an increase in, if you call it wages, was the Social Security contract, going up 8.7%, which was tied directly to inflation. But the union contract for railroads was a 5% increase.
But it was also some big cash that they were handing out.
There was some big cash. So that is when
the next 3 or 4 years you're talking about increases.
I think if everything goes down and wages go up, we actually should be happy. And we wanted people to get more money, and we want the average American to do better.
No, we do. It's just how much of that feeds into the inflationary numbers. Do we really get to 3 to 4% if you have a lot of 3, 4, 5-year contracts that are signed right now?
Well, that's why it'll stay at 3 or 4 and won't go to 2. It'll be very hard to get it to 2, and it's not necessary. I think the Fed doesn't appear to understand the ramifications of what they're doing. As Joe was talking earlier about, hey, a 4-year number is not a bad number, 5-year number is bad. It's the pace. It's not the level. It's the fact that he did the fastest increase in history and destabilizes markets that can't react. People don't even know how to value properties right now. I mean, you're seeing trades close. We sold a bunch of apartments at a 3.8% yield, but that's not the going number today. And nobody knows exactly where values are, because at the time, at these inflection points when economies are rolling, there's a pretty wide bid-ask spread between the guy who wants the price he could have gotten yesterday and the guy who wants the great opportunity today.
Right.